All right, fellow finance fanatics, welcome back to the deep dive. I know you're all knee-deep in CFA Level 2 prep right now, so we're going to tackle a topic that might make you feel like you're drowning in formulas.
The cost of capital.
The cost of capital.
Yes, the cost of capital.
It's one of those concepts that can seem a bit dry at first.
It can.
But trust me, it's absolutely crucial for understanding valuation and making smart investment decisions.
Absolutely.
Okay, so let's convince our listeners that the cost of capital isn't as boring as they might think.
Okay.
What's the elevator pitch? Why should they care about this stuff, even if they'd rather be studying something a bit more glamorous like portfolio management?
Because the cost of capital is like the foundation of everything in finance.
Ooh.
It tells us how much a company needs to earn on its investments to satisfy its investors,
Okay.
both those who lend it money and those who own a piece of it.
Got it.
Think of it this way. If a company can't earn more than its cost of capital, it's essentially destroying value.
Yeah. So it's like a financial hurdle the company has to jump over to actually create value for its shareholders.
Exactly.
Okay.
And if we're trying to value a company or make investment decisions, we absolutely need to know what that hurdle is.
Right. I'm sold.
Good.
But let's break it down a bit further for our listeners who are still trying to wrap their heads around all the formulas and concepts.
Okay.
When we talk about cost of capital, what are we really talking about?
We're talking about the weighted average cost of capital, or WACC.
WACC.
It's a blend of the cost of debt and the cost of equity,
Okay.
taking into account how much of each a company uses to finance its operations.
Okay. That makes sense.
Yeah.
So a company that relies heavily on debt financing will have a different WACC than a company that's mostly funded by equity.
Precisely.
Okay.
And that's what makes calculating WACC so interesting. There's no one-size-fits-all formula.
Interesting.
It depends on the company's specific capital structure and a bunch of other factors like its risk profile, the industry it operates in, and even the overall market conditions.
Okay. I'm starting to see why this isn't just a simple plug-and-chug exercise. There's a lot of nuance and judgment involved.
There is.
But let's start with the basics.
Okay.
How do we actually break down that WACC formula?
The formula itself is pretty straightforward.
Okay.
We take the cost of debt,
Yeah.
multiply it by the proportion of debt in the company's capital structure, then add that to the cost of equity,
Okay.
multiplied by the proportion of equity.
Right. So far, so good. But I'm guessing the tricky part is actually figuring out those individual costs, the cost of debt and the cost of equity.
You got it.
Okay.
And that's where we'll really start to see how all these factors we've been talking about come into play.
Well, let's dive in then. Let's start with the cost of debt.
Okay.
It seems like that should be the easier one to figure out right after all debt comes with a stated interest rate.
It can be that simple.
Yeah.
Especially if a company has publicly traded bonds. We can often use the yield to maturity on those bonds as a reasonable proxy for the cost of debt.
Okay.
That yield reflects what investors are currently demanding to lend money to that company.
So the market is basically telling us what the company's cost of debt is.
Yes.
But, hold on.
Yeah.
Isn't there something about taxes we need to consider?
You're absolutely right.
Okay.
We can't forget about the tax man.
Right.
Interest payments on debt are typically tax deductible, which means the company's actual cost of debt is lower than the stated interest rate.
So we need to factor in the company's tax rate to get a true picture of their cost of debt.
Exactly. We want the after-tax cost of debt,
Okay.
which we calculate by multiplying the pre-tax cost by 1 minus the company's marginal tax rate.
Okay, that makes sense.
Yeah.
But what about companies that don't have publicly traded debt?
That's when things get a bit more challenging.
Challenging how?
We have to get creative and play detective.
Ooh, I like a good financial mystery.
Well, imagine we're looking at a manufacturing company that doesn't have bonds trading in the market to figure out their cost of debt.
Yeah.
We might look at their financial statements and compare their creditworthiness to similar companies with publicly traded debt.
So we're essentially trying to estimate what their debt would cost if they did issue bonds.
Yeah.
But how do we assess their creditworthiness if we don't have a bond rating to go off of?
We can look at metrics like their interest coverage ratio,
Interest coverage ratio.
which tells us how easily they can cover their interest expense and their debt to equity ratio,
Right.
which gives us a sense of how much debt they're using relative to equity.
Yeah.
We can then compare these ratios to companies with similar risk profiles and known credit ratings.
So it's kind of like giving the company a hypothetical credit rating based on how they stack up against their peers.
Exactly.
Okay.
And once we have that synthetic rating,
Yeah.
we can look at the yields on bonds with similar ratings and maturities to estimate what our company's debt would likely cost.
I'm starting to see how this all ties back to the idea that there's no one right way to calculate WACC.
Right.
We have to adapt our approach based on the specific information available.
We do.
But let's say we've done our detective work and come up with a reasonable estimate for the company's cost of debt.
Right.
What about the cost of equity? That seems a lot more intangible.
It is more complex because unlike debt, equity doesn't have a stated interest rate.
Right.
We need to figure out what return investors expect to earn on their investment in the company's stock.
Okay.
And that brings us to the exciting world of the equity risk premium.
Here we go. The equity risk premium. It sounds intimidating, but I'm ready to conquer it.
It's really not as scary as it sounds.
Okay.
The equity risk premium is simply the extra return that investors demand for holding risky stocks instead of safe government bonds.
Okay.
It's the compensation they require for taking on that additional risk.
Okay, that makes sense. Riskier investments should come with a higher potential reward.
It should.
But how do we actually figure out what that premium should be?
Yeah,
I'm guessing there's no simple formula for that.
you're right, there isn't.
Okay.
But there are two main approaches we can use.
Go.
The historical approach and the forward-looking approach.
Let me guess. The historical approach involves looking at past data to see what kind of premium investors have typically demanded.
Yes.
While the forward-looking approach is a bit more like gazing into a crystal ball and trying to predict the future.
You're catching on quickly.
Okay.
The historical approach is all about analyzing past returns to see how much more the stock market has returned compared to government bonds over a long period of time.
So if we see that the market has historically returned, say, 6% more than government bonds on average,
Okay.
that gives us a starting point for our equity risk premium.
It could.
But I'm guessing there's some caveats here.
Definitely. The biggest one is that we're assuming the past is a good predictor of the future.
Yeah.
What if market conditions have changed dramatically?
Right.
Or what if there were some unusual events in the past that skewed those historical returns?
Right, like that little thing called the 2008 financial crisis that probably threw a wrench into some historical averages.
Exactly. Even in less dramatic times, things like inflation, interest rates,
Yeah.
and economic growth can all change significantly,
Right.
making historical data less reliable.
Okay, so relying solely on the historical approach seems a bit risky.
It can be.
What about the forward-looking approach?
Right.
How do we try to predict the future equity risk premium?
One common method is to use the dividend discount model, or DDM.
The GDM.
We can use a company's expected future dividends,
Okay.
their current stock price,
Uh-huh.
and their expected growth rate to figure out the return that investors are demanding.
Okay.
Then we subtract the risk-free rate, and voila, we have a forward-looking equity risk premium.
So we're basically using the market's expectations about a company's future performance to determine the premium. But that seems like it relies heavily on accurate forecasts,
It does.
which can be tricky to come by.
Which is why analysts spend so much time trying to get those forecasts as accurate as possible.
Right.
But even with the most meticulous forecasts,
Yeah.
there's always going to be some uncertainty involved.
Of course.
And that uncertainty is magnified when we start talking about international markets.
Yes. Those pesky country risks. I knew they'd come back to haunt us.
They always do.
Right.
When a company operates in multiple countries, especially riskier ones, we need to adjust their equity risk premium accordingly.
Okay.
Those country risk premiums reflect the additional political, economic, and regulatory risks associated with investing in those foreign markets.
So it's like we're adding extra layers of risk onto the base layer of the equity risk premium, depending on where the company operates and how risky those markets are.
A perfect analogy.
I like it.
And once we have that premium nailed down, we can finally move on to actually calculating the cost of equity itself. But I think we've given our listeners plenty to digest for now.
Agreed. Let's take a break and come back to tackle those cost of equity calculations in part 2. Welcome back to the deep dive. I feel like we're finally ready to crack the code on calculating the cost of equity. But before we jump into the formulas, can we take a step back
Sure.
and remind ourselves why this is such an important concept?
Absolutely. The cost of equity is all about understanding what return investors expect to earn on their investment in a company's stock.
Okay.
And remember, those expectations are driven by risk.
Right.
Investors want to be compensated for taking on the risk of owning a piece of a company.
Right. So the riskier the company, the higher the cost of equity.
That's right.
But how do we actually quantify that risk and translate it into a specific percentage return?
That's where those cost of equity calculation methods come in. We talked about the equity risk premium in part one,
Yeah.
which gives us a baseline for how much extra return investors demand for holding stocks versus risk-free assets. Now we need to apply that premium to a specific company, taking into account its individual risk profile.
Okay, let's get into the methods then. I remember you mentioned the dividend discount model, or DDM.
Yes.
How does that work for calculating the cost of equity?
Imagine you're an investor looking at a company's stock. You see its current price, and you have an idea of its future dividends and how they'll grow over time.
Okay.
The DDM lets you work backward and figure out what return you'd need to earn to justify that stock price,
Uh-huh.
given those dividend expectations.
Okay.
That required return is essentially the company's cost of equity.
So if a company is expected to pay out a lot of dividends, and those dividends are expected to grow rapidly,
Yeah,
that suggests investors would be willing to accept a lower return, right?
exactly. The DDM captures the idea that investors are willing to pay more for a stock today if they believe they'll receive a steady stream of growing dividends in the future. But of course, not all companies pay dividends.
Right.
Especially those high-growth tech companies that are reinvesting all their profits back into the business.
Yeah. Okay, so the DDM isn't a one-size-fits-all solution.
Right.
What other methods can we use when the DDM isn't appropriate?
Another approach is the bond yield plus risk premium method, or BYPRP.
Bond yield plus risk premium.
It's a bit like comparing apples and oranges,
Uh-huh.
but it can be quite effective. We start with the company's cost of debt,
Okay.
which we can usually get from the yield on their bonds.
Okay.
And then we add a risk premium to reflect the fact that stocks are riskier than bonds.
So we're basically saying, hey, if investors are willing to accept a certain return for lending money to this company,
Yeah.
they'll surely demand a higher return for owning a piece of it.
Precisely. The tricky part, as always, is figuring out how big that risk premium should be. We can look at historical data to see how much higher stock returns have been compared to bond returns for companies with similar risk profiles. But as we discussed earlier, relying solely on historical data can be problematic
Yeah.
if market conditions have changed or if there were unusual events that skewed those historical returns.
Right. It's always important to consider the context
Yeah.
and not blindly rely on past performance as a guarantee of future results.
It is.
But what if we're not comfortable using either the DDM or the BYPRP? What other tools do we have in our cost of equity toolbox?
That's when we turn to those more sophisticated risk-based models like the capital asset pricing model or CAP.
Yes. CAPM, every finance student's favorite three-letter acronym. Can you give us a quick refresher on how that works?
CAPM says that a stock's expected return is equal to the risk-free rate plus beta times the market risk premium.
Okay.
So we start with the risk-free rate, which is usually the yield on a government bond.
Uh-huh.
And then we add a premium to account for the stock's volatility relative to the overall market.
Okay, so the higher the beta, the higher the expected return. It's like saying if you want to ride this roller coaster, you have to pay a premium for the extra thrills and potential spills.
Exactly. But CAPM isn't the only risk-based model out there. There's also the FAMA French model,
Okay.
which takes CAPM a step further and adds two additional factors, size and value.
Tell me more about these extra factors. Why are they important?
The FAMA French model recognizes that smaller companies and companies with a high book-to-market ratio tend to outperform the market over the long term.
Okay.
So it adds premiums for size and value to account for these additional sources of risk and return.
So it's acknowledging that there's more to risk in return than just a company's beta.
Mm-hmm.
We need to consider other factors that might affect its performance.
Absolutely. And this is where things get really interesting because those extra factors are particularly relevant when we start talking about private companies.
Private companies, those can be a real headache for valuation, right?
They can be tricky for sure because private companies don't have publicly traded stock. We can't just plug their numbers into CAPM or FAMA French and call it a day.
So how do we estimate their cost of equity? Do we just throw our hands up in the air and say it's impossible?
Not quite. We just need to adapt our approach. We can use the expanded CPM,
Expanded CPM.
which is essentially the regular CAPM, but with some added premiums to account for the specific risks associated with private companies.
What kind of extra premiums are we talking about?
Well, private companies are often smaller less established, and have more concentrated ownership,
Yeah.
which all adds to their risk profile. So we might add a size premium,
Uh-huh.
a company-specific risk premium,
Okay.
and potentially even a liquidity premium to reflect the fact that their shares are harder to buy and sell.
So we're building up the required return to reflect all those layers of risk that come with investing in a private company.
Exactly. And if the expanded CAPM feels a bit too complex, there's the build-up approach, which is more straightforward.
Okay.
We start with the risk-free rate and then just keep adding risk premiums on top of that layer by layer.
Yeah.
A premium for market risk, a size premium, an industry risk premium, and a company-specific risk premium.
It's like building a risk pyramid.
Right.
We keep adding blocks until we feel like we've accounted for all the relevant risks.
Yeah. Precisely. But it's not just about blindly adding premiums. We need to justify why those premiums are appropriate for that specific company.
Right. So it still requires a good understanding of the company, its industry, and the overall market context. We can't just pull these premiums out of thin air.
Absolutely. And just when you thought we'd covered all the bases, there's one more wrinkle: international considerations.
Oh, no, not those pesky country risks again. I thought we had escaped their clutches.
They always find a way to creep back in when a company operates internationally, especially in emerging markets. We need to adjust their cost of equity to reflect those additional risks.
So those country risk premiums we talked about earlier make a comeback.
You got it. And there are a couple of ways to incorporate those premiums. We can use the country spread model,
Okay.
which compares the yields on government bonds in the foreign country to the yields on U.S. Treasuries.
Okay.
A bigger spread suggests a higher risk, so we add a corresponding premium to the company's cost of equity.
It makes sense that a country with riskier bonds would also have riskier stocks. What other methods can we use for international companies?
There's also the international CAPM or ICAPM, which takes into account not only the company's exposure to the global market, but also their exposure to fluctuations in exchange rates.
Okay.
Because when a company earns revenue in a foreign currency, those earnings are worth less if that currency depreciates against their home currency.
Ah, so ICIPM captures the added risk of currency volatility. That makes sense.
Exactly. And as with all our other methods, choosing the right approach depends on the company's specific circumstances and the availability of reliable data.
Wow, we've covered a lot of ground in this episode.
Uh-huh.
From simple dividend discount models to complex international CAPM calculations. My brain is definitely feeling a bit full, but in a good way.
I'm glad to hear it. It's a lot to take in, but remember, understanding the cost of capital is like having a superpower in the world of finance. It allows you to make informed decisions about valuation, investment, and even corporate strategy.
Well said. But I think we need to give our listeners a chance to catch their breath and process all this information. Let's wrap up this deep dive with some key takeaways and a final thought-provoking question in part 3. Welcome back to the deep dive. You know, we've been on quite the journey exploring this intricate world of cost of capital.
Yeah, from that like foundational WACC formula
Wow.
to like those nuanced calculations for the cost of equity.
Right.
We've covered a lot.
We've covered a lot of ground, but I think our listeners are starting to see why this topic is so crucial for anyone serious about finance,
It is.
whether they're prepping for the CFA exams or making real-world investment decisions.
Absolutely. Understanding the cost of capital is like having a secret decoder ring for the financial markets.
Ooh, I like that.
It allows you to assess the potential return on an investment and compare different opportunities on a level playing field.
So let's bring it all home for our listeners who are probably eager to get back to their CFA study guides.
Okay.
What are some key takeaways they should remember from this deep dive?
First and foremost, there's no one-size-fits-all approach to calculating the cost of capital.
Right.
The best method depends on a variety of factors like the company's industry, its size, its financial structure, and even the overall market environment.
Right. It's all about choosing the method that's most appropriate for the specific circumstances.
Yes.
We can't just blindly plug numbers into a formula and expect to get a meaningful result.
We can't.
We need to understand the underlying assumptions and limitations of each method and use our judgment to adapt them to the situation at hand.
Exactly.
Another important takeaway is that both debt and equity have a cost.
They do.
Sometimes people get so focused on the interest rate on debt that they forget that equity investors also expect a return on their investment.
That's true. That's where the equity risk premium comes in.
The equity risk premium.
It's the compensation investors demand for taking on the risk of owning a company's stock, and it can vary widely depending on the company's risk profile and market conditions.
And let's not forget about those company-specific risk premiums, especially when we're dealing with private companies.
Especially with private companies.
Those premiums reflect the unique risks associated with each individual company,
They do.
and they can have a significant impact on our valuation.
Absolutely. We need to carefully assess factors like management quality, competitive position, customer concentration,
Yeah.
and even geographic risk when determining those premiums.
And of course, we can't forget about those pesky country risks.
We can't.
If a company operates internationally, we need to adjust their cost of capital accordingly to reflect the additional political, economic, and regulatory risks they face.
All about layering those risks on top of each other to arrive at a comprehensive cost of capital
Yeah.
that accurately reflects the company's overall risk profile.
So it's safe to say that mastering the cost of capital is an ongoing journey, not a destination.
It is.
There's always more to learn and new challenges to tackle.
Absolutely. And that brings us to our final thought-provoking question for our listeners.
Hit me with it.
Knowing how to estimate the cost of capital is one thing.
Okay.
Knowing how to apply it to make informed investment decisions, that's where the real challenge and the reward lies.
It's a great reminder that financial analysis isn't just about crunching numbers. It's about using those numbers to understand the bigger picture,
It is.
assess risk and return, and make smart decisions that create value.
Absolutely.
And on that note, I think we've officially reached the bottom of this deep dive.
We have.
Thanks for joining us on this epic cost of capital adventure. We'll see you next time on the Deep Dive.